we have noticed that institutions are starting to sell a lot of shares, and in fact over the last few months it isn't just them, but we can also see hedge funds as well as retail selling more stock than they are buying, leaving only the index and ETFs to buy shares. Now, on top of that, when we look at the wider market, we can see that Berkshire Hathaway, their cash position, as I'm sure you're aware, has reached all-time highs. In fact, Warren Buffett is selling many shares, not just Apple, but also Bank of America, just to name a few. And what's very interesting to point out from this information, but he's also frozen their share buyback program, which means he doesn't believe there is any value in buying these shares in what he can see as an overly inflated market. Now, you just need to look at the P ratio of 30.7 to tell you how high it's currently sitting, and there are no surprises. A lot of companies, institutions, and even hedge fund managers are starting to sell. Now, today's episode, we are going to look at 5 stocks where institutions have been selling over the last quarter, over the last 12 months. Now, the first one we're looking at is Lululemon. Now, it will be the only non-dividend paying stock we'll look at. These 5 stocks are just a selection of many that we have noticed institutions taking money out. Now, first thing to note with Lululemon, it does have 85% institutional ownership. We noticed over the last year around 6.7 billion worth of sales, and in the same time frame we do get marginally more buys by these institutions. However, what we want to draw your attention to is that just in the more recent quarter, they have been selling nearly double the amount they have been buying. That is 2.62 billion versus 1.43 billion. And we do believe when the updated dataset is released for Q4, it will show for Lululemon that the institutions are continuing to sell. Now, when we look at this company over the longer term, well, right now it does trade in the lower end of the 52-week range. We do get a double buy signal from Seeking Alpha and Wall Street with a hold from Quant. As we said, the only one today that doesn't pay a dividend, and in terms of a forward P, around 23. Now, over the last year, it has been hammered down 27%. If you've been a longer term shareholder though, you would be up around 600%. And without those dividends, this company would have still outperformed the S&P 500. Now, when we look at the company in terms of their metrics, typically free cash flow, we want to see consistent growth over the longer term. And whilst we see growth, in fact, around 10 times from 2015 to 2024, we do get periods where it is inconsistent, notably 22-23, but over the next 12 months, it is anticipated to increase to 1380. We also note on the sales growth where we want to see at a bare minimum 3 to 4% just to keep up in line with inflation. This company has produced double digits to their top line every single year, and 13% is noted on a trailing 12 month. Then when we zoom out and look at their total sales, pretty much 5-fold increase from 2015 to 2024, and whilst they don't pay out a dividend currently, they return excess cash to investors through another way. That, as we can see, are those share buybacks. Not a lot, to be honest, but there is a minimal amount and something just to consider, and you could classify it as a nice bonus. ROIC, that is one of our most favoured metrics. 10% or more. Give us faith, management are able to effectively allocate their capital. These numbers that Lululemon have produced on a year-on-year basis, very, very strong. 42% as well. We like to see that on a trailing 12 month, and I'm sure investors and potential investors will find that very, very attractive. Now, operating margin, we want to see 2 things. Minimum 16%, which they do hit. Second thing, we want to see efficiencies. That means margins increasing over the longer term. And you could argue we get a little bit of that over the last 10. We then finally get to the net debt to EBITDA alongside the ROIC, another favoured metric here. EBITDA referring to earnings before interest, tax, depreciation, amortization, and the numbers that you see here are the number of years it would take the company to pay off all of their debt net of cash on hand. Remember, this also correlates to the balance sheet strength, and this tells us over the last 5 years and on the trailing 12 month and over the next 12 months, for Lululemon, it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. That is a very, very strong balance sheet, and we do quite like the consistency over the last 5 years. Now, for each one of these companies, we are going to run through their valuation, give you our own thoughts, even though institutions have been selling, whether we believe it to be a buy, hold, or sell. And our valuation today comes at $368 for this company, derived from the DCF model. Now, we're going through a few companies today, so we won't look at all of them in detail, but we'll show you quickly how we got to this value for this company so you get an idea moving forwards. We have the free cash flow year on year, very large growth over the last 10 years at 62% on average. Moving forwards, we've gone for 8%, where we do have a low, medium and high rate, and with the discount rate, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, our intrinsic value, which indicates right now around 15% upside. Now these numbers are subjective and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Lululemon or any others. Now for transparency, we will just show you for those that believe 6% is more appropriate, 319 indicating no upside, pretty much the fair value if you believe growth at 6% is more appropriate, and those who are a lot more optimistic at 10%, $424 indicating 32% upside. So let's take through the medium rate, what we will ultimately do for each company, and apply a margin of safety, 10% to start off with, and we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, well, this company is a buy up to $331. Then we keep going till it's near the current trading price. Now, not at the 15% level just yet. That would be around 312. And for those that want to see 20% MOS, a buy at 294, 25 around 276, and at the 30% point around 257. So today's episode, we see between 10 to 15% margin of safety for Lululemon, and Wall Street, they see around 8% upside. Their price target is $345. So ultimately, we don't believe this is a company to buy just yet. 10% or 10 to 15 in fact isn't sufficient, and Wall Street don't see this climbing too high over the next year. So as always, give us your own thoughts. As we said though, we will let you know based on the MOS and Wall Street forecast whether we believe this is one to consider. We then move on to Altria Group with institutional ownership of 57%. We see around 3.3 billion worth of sales over the last year, which is higher than the amount of buys. So we can see over the longer term, institutions are slowly starting to get rid of Altria stock. However, in the more recent quarter, we do see a little bit more buying than selling. So overall, we can see institutions little by little are selling off this company. Whether or not it will continue over the next few quarters is definitely something we will keep our eye on. But it's interesting to note this company is now trading at its 52-week high at $58 with only one buy rating from Seeking Alpha, a double hold from Wall Street as well as Quant. With a forward yield now at 7.08%, it does feel very low. If you are someone who did buy at the 52-week low, that yield would have been nearing the 10% point, and the forward P right now sits at just above 11. Over the last year, well, very strong, maybe not something you would think for a tobacco company like Altria, but it is up nearly 40%. Over the last 10 years, however, it is up only 14%, and we can see all-time highs. You would have to take a time machine back to June 2017, where it was trading around $77. Now, in terms of their dividend safety, we get a 55 borderline safe score. We'll talk about these two models shortly, but nice to see for a high-paying dividend company, a 4.1% increase, which is in line with inflation. That is something that I definitely have no issues with, and it was reaffirmed a few weeks ago, borderline safe, which ultimately means there is a moderate risk of a dividend cut over a full economic cycle. Now, we can touch upon that as well. Key metrics then from the last recession, 07-09, they increased the dividend. They had below average growth massively, negative 50%, S&P was negative 12, but look at that, they also massively outperformed in terms of return, probably something you would be more interested in, and negative 55 was what the S&P recorded. In terms of dividend growth, well, nice to see also over the last 5 years, they've been increasing those dividends in line with inflation. However, it is a little bit subpar when we do zoom out over the last 20 years at 2%, but also very important to understand they are a dividend king. Now, we do like dividend kings here on this channel, but also word of caution, just because a company is a dividend king, which means 50 plus years of dividend increases, it doesn't mean that will continue into the future. We have had some just in 2024 that were a dividend king that ultimately ended up cutting their dividend. Now, in terms of valuation, based on the forward PE, what we notice here is the blue tunnel is the expected fair price. Right now, this is sitting outside that for the first time in 2024, indicating overvaluation. But remember, we will run this through the model shortly as well to give our own perspective. Dividend yield theory tells us a company is undervalued when the current yield sits above the 5-year average. We see the opposite, that is another overvaluation signal, and we can see that on the forward PE, 10.8 is above the 9.3, so we're seeing a lot of overvaluation, although we do notice it is lower than the consumer staples at 18.8, therefore trading at a discount to the sector. But ultimately, for a better comparison, we should look at the tobacco industry itself rather than the consumer staples. Now, free cash flow, we didn't mention it earlier, but we do prefer to look at that data over the earnings, which is susceptible to manipulation by management through accounting. Below 85% is what we want for tobacco companies. They have hit that since 2018, so that does look promising, although we do notice over the next 12 months, it is anticipated to creep up slightly to 89. In terms of free cash flow per share, well, over the longer term, more than double, which is a great sign. But again, we should point out over the next 12 months, it is anticipated to drop to $4.60. We then move on to sales growth. Now, bear in mind, this industry has started to struggle over the longer term, which is why we don't even get that inflationary increase on a consistent basis. Just the last 2 years, they have been negative on their top line revenue, and we notice the exact same expected, purely down to the trailing 12-month being negative 1%. There we go, on a numerical basis as well, quite easy to spot that we aren't getting that inflationary increase, but this isn't ultimately an important metric. If you are an investor in a company like Altria, you probably are using this for the dividend and perhaps as an income investor using it for your daily expenses. Very nice to see though, they also return excess cash through those share buybacks, maybe not at a quick rate, but if you're getting a high yield, at least an inflationary increase in the more recent time, and some small share buybacks here and there, then you could take that as a small win. ROIC, we want above 15% for tobacco companies. That is what we get every single year. Very strong to note. We don't actually see that on British American Tobacco, which is a comparable competitor. So that is a positive for those that do prefer this over the BTI. Operating margin, well, love that. Very, very clear operating efficiencies over the longer term. And free cash flow margin, definitely a free cash flow machine. Then we move on to a very important metric for this company, given they pay a very high yield and that we saw a borderline safe dividend score. Below 3 is what we want. That is what we get, although we do notice it has creeped up on the trailing 12 month. Nice and reassuring to see over the next 12, it is anticipated to come down to 1.83. But again, something we would keep our eye on, especially if you are an investor. Now, in terms of the valuation, and we do also want to let you know, this is one that we do hold in our portfolio, we get an intrinsic value of $57. With the current price, right now we believe this company is trading at fair value, so you aren't going to be getting any margin of safety. But again, we'll run it through just to show you. 10% a buy at $51, 15 around 48, at 20% around 46, and at 25 around 43. Again, this company was trading around a 30% margin of safety within the last 52 weeks, but right now, as we said, we believe this is trading ultimately at a zero margin of safety, therefore at fair value. Wall Street, on the other hand, believe over the next 12 months, this company will go down around 8% at $53. This is also one, as we said, we have in our own portfolio. It's not one we're buying at the moment. It's also not one that we're selling. Right now, we believe this is a hold, and do give us your thoughts below. We also want to let you know we have released our latest free weekly article where we run through 2 beaten down stocks with over 30% upside. Now we release one every single Monday morning to your inbox, and we talk about severely undervalued stocks that deserve your attention, as well as what's gone in the market over the last few days. So click below, you can sign up and start reading straight away. You'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released spreadsheet that runs through 29 undervalued dividend stocks that Wall Street themselves believe have the most upside right now in the whole S&P 500. So click below, you can sign up and read straight away. We then move on to one that Warren Buffett himself has been continuing to sell, not just on a quarter by quarter basis, but also on a very rapid rate over the last few months. We notice Bank of America, 71% institutional ownership, 15 billion worth of sales over the last year. Now we do get a little bit more buying over the same time period, but the thing that really stands out, why we have included this in today's episode, is that just in the more recent quarter, institutions have been selling a considerable amount, 4 times more in fact than they have been buying. Definitely one we would say just to think about if you are a shareholder or someone considering adding. Now, very similar to Altria Group, this company is trading at its 52-week high. What a ride that is from the 52-week lows of $30. Now, we only notice Wall Street giving this a buy, although you could argue seeking alpha and quant not too far off the 3.5 to flip to a buy rating. In terms of yield, 2.2%, forward PE just below 15. Over the last year, well, up 62%. If you've been a longer term shareholder, you probably would have marginally outperformed the S&P, up 171%. In terms of dividend safety, well, similar to Altria Group, a borderline safe score of 55, and we also get, as we'll talk through, a double overvaluation signal. It is nice, however, to report they did increase that dividend at a very attractive rate of 8.3% in June this year. Now, their safety score was reaffirmed in October, so again, just a month ago, and similar, like we just saw with the previous company, a moderate risk of a dividend cut over a full economic cycle. Now, in terms of their recession dividend, they actually cut the dividend. They had below average growth. That is an insane negative 92% recession return. I'm not sure I've come across one worse on this channel. And as we can see, trailed the S&P, which itself was down negative 55. Now, nice growth as we saw in June. Nice growth over the last 5 years. However, negative 2% over the last 20 does let us know they have had a dividend cut over the last 20 years. As signaled once in 2007 and another in 2008. In terms of looking at this company then from the valuation perspective, we can see over the last 12 months and more in fact recently the last few weeks, this company has now gone into severe overvaluation territory above that blue intrinsic fair price. In terms of dividend yield theory, well, we can in fact see it is lower. That is an overvaluation signal. In terms of the forward PE, that is above another overvaluation signal. And if you want to compare it, it is pretty much trading around the financial sector of 13.8. Then when we want to draw your attention to the free cash flow, we do have to say that for banks, they are a lot more volatile in terms of the cash flow. That is why we have to go back to looking at the earnings. Below 40% is what we want to see. That is what we get consistently, anticipated around 30% over the next 12 months. So no worries there. We do expect another, at bare minimum, high single digit increase from this company. EPS has looked inconsistent, although it does move in the right direction, and we also like the fact over the next 12 months it is anticipated to increase to 351. In terms of their EPS growth, well, we can see lots of fluctuations on a year-on-year basis, very large swings. Over the last 12 months, negative 23%. I guess you could take some faith that over the next 12 months, this is expected to increase around 28%. And we can see, if you like to look at these sales from the banks, again, looking very, very inconsistent, negative 2% on a trailing 12 month. Now, shares outstanding, this is at least one very positive sign. They have bought back quite a number of shares. In fact, around 20% of shares outstanding in 2014. So that is one nice way to be rewarded as a shareholder. As we said, returning excess cash to shareholder pockets. And then we move on to effectively the ROE, the return on equity. Above 9% is the target for the industry. We get that over the last few years in terms of straddling around the 9%. 8% on a trailing 12 month, maybe something just to bear in mind. It has started to come down over the last few years. We then move into our valuation of BAC. Now, our intrinsic price of $43 does indicate right now it is trading in overvaluation territory. You get no margin of safety. In fact, if you wanted 10% at a bare minimum, you would have to wait for $39, at 15% around $37, at 20% around $35, and as we can see, 25%, $32, it was there within the last 52 weeks. Now, while we do believe this is trading at an overvaluation similar to the other signals we have just seen, Wall Street, on the other hand, with their limited upside of 2%, believe that Bank of America is trading right now around its fair value, something that maybe has no surprises given the news that Warren Buffett has been selling a lot of shares in this company. But as always, never ever copy what institutions do, never copy what insiders do, always do your own due diligence before executing on any company. We then move on to Hershey Company, around 58% institutional ownership. Now, a massive amount of selling of $12.4 billion when you do compare that to the buys of only 3. So what we notice, institutions over the last year, they are selling around 4 times as much as they are buying, and we get pretty much over the last 2 quarters, very minimal difference between the buys and sells. So something just to think about. Hershey, for the time being, isn't one that institutions want to hold in their portfolio. In terms of looking at the company, though, it is trading, unlike the other ones we have seen today, towards the lower end of the 52-week range. We get a buy rating from Seeking Alpha, nowhere near a buy from Wall Street and Quant, who both believe this should be a hold. In terms of a yield, over 3%, 3.15, forward PE at 19.2, and over the last year, down 7.6%. Over the last 5 years, up only 17%. Over the last 10, we can see underperformance of the S&P. And if you are someone who did buy on May the 1st, 2023, that was the top for the time being, $275. It has come down significantly since then. In fact, right now it is trading at $100 a share less. In terms of the dividend safety, well, nice to see a safe score, double severe undervaluation with a nice double-digit increase in February, something that they do on a historical basis at a very attractive rate. Now, it was reaffirmed literally 1 week ago that the dividend is safe, and that means a dividend cut for Hershey is unlikely. Now, we do notice the recession dividend, they maintained it, didn't increase, didn't cut it. They had pretty much flat sales. Remember, that is above the -12 of the S&P, whilst also outperforming in terms of return, -30%. Always good to see this double digit very consistently. That is ultimately what dividend growth investors want to see. Rapid rate increase to the dividend, as well as obviously the share price. Now, they've only been increasing the dividend for the last 14 years, but we do like the fact that they have been paying one for the last 94 years without a reduction. In terms of the valuation space, well, we did already mention it earlier on, severe undervaluation. That is effectively a consistent trend over the last year. Right now as well, that does apply below the bottom end of the fair price, and is therefore severe undervaluation. Something that is confirmed again, both yield very high, in fact the highest over the last 5 years, and the forward P 20.8 below 23.9. However, we do notice it is still trading at a marginal premium to the overall consumer staples of 18.8. In terms of free cash flow payout, no real worries. It is below 70% pretty consistently, 61 anticipated over the next 12 months. And we do like the fact that over the longer term, it has been increasing the free cash flow. Not too bad, not much inconsistency. And over the next 12 months, anticipated to increase to just under $9 per share. Now, in terms of sales growth, looking good over the last 3 years in particular, but we can see 2024 probably not the best year with a potential decrease to their top line revenue. Nonetheless, over the longer term, whilst it has been very slow and steady, we do see around 40% increase to their top line. They also do some share buybacks. We won't go into too much detail as it is fairly trivial over the longer term. And their ROIC, which has also been decreasing, but we can see above 12%, does look very good, very healthy in the mid-20s over the last 6 years. Operating margin, very marginal operating efficiency and above the 16, so that is definitely a win. Above the 7% on the free cash flow, so again, looking fairly positive. And the net debt to EBITDA, well below the 4 that we want to see for the industry on a very consistent basis, and a marginal increase is anticipated to 1.78. That is still below the maximum 4, something that we do like to see. Now, the intrinsic value of $203 does give us a margin of safety today. At 10%, a buy at 183, at 15%, pretty much where we see this company right now, with Wall Street believing upside of around 12%, their price target $195. Now, this is one that you could consider to buy, we would say on a hold or a buy, depending on what type of investor you are. Are you someone who does want to collect that dividend while waiting, with the hope that cocoa prices will come down and that this will ultimately go back way past the all-time highs? Or maybe you want to see a little bit more growth in the future that is definitely sustainable? That are the questions maybe you need to consider for the Hershey Company. As always though, do give us your thoughts below. We then move on to PepsiCo with around 73% institutional ownership, around 16 billion worth of sales over the last year, and we see less amount of buyers of around 14.4 billion, although we can see in the more recent quarter institutions have bought more. So maybe this is something that they're seeing the share price has started to come down, they want to take advantage of, or in fact over the longer term they will continue to slowly sell more and more shares out of their portfolio. Then we get to the actual company itself with only one buy rating from Quant. Very interesting. This is probably the rarest thing that we have seen on the channel. A buy from Quant with the other two analysts giving it a hold. That is seeking alpha and Wall Street, although we can see both aren't far away from flipping to a buy. We also notice it isn't far off the 52-week low, an attractive yield at 3.33, a forward PE just below 20. Now, over the last year, down 3%. Over the last 10 years, it is up 66%, but you would have underperformed the S&P. We do get our first very safe dividend score at 93, a double severe undervaluation with an attractive high single-digit increase to the dividend of 7.1% this year. Now, it was reaffirmed literally last month. Very safe means a dividend cut is highly unlikely. Last recession, while they increased the dividend, they pretty much had flat growth whilst also outperforming the S&P negative 35%. And we can see nice dividend increases is something that is fairly consistent and typical from PepsiCo. And music to our ears, we have a dividend king, 51 years of consecutively increasing that dividend. In terms of the valuation then, when we do zoom into over the last year, pretty much on a consistent basis, it has been trading at severe undervaluation, although we can see that gap widening just over the last few weeks. In terms of dividend yield theory and the forward P, again we get confirmation of double undervaluation, and when we compare it against the consumer staples, it isn't far off, pretty much trading in line with the overall sector. Maybe something you believe right now is attractive because you believe this company should be trading at a premium. Now, one thing we don't like, and again, the reason why we look at the free cash flow over the earnings, 116% on a trailing 12 month, 111 in 2022. These are what we call red flag indicators, telling us that management paid out more in dividends than they generated in free cash flow whenever we see that triple digit. I guess the positive you could say, over the next 12 months, expected to come down to 70%. We then move on to the free cash flow, very inconsistent, minimal growth, but nice growth anticipated over the next 12. Good to have realistic expectations with these type of companies. You're not going to get the growth that you'd get to tech companies or anything similar. In terms of sales growth, well, not looking too bad over the more recent period, although on the trailing 12 month, we do get a sign of weakness with 0%. And then we move on to the total sales. Again, that is better reflected here in terms of the actual growth. Not the greatest, but again, this is what we should expect moving forwards for this company. Shares outstanding, they have done some share buybacks, fairly trivial, not really part of their prioritization of capital allocation. And then we get to the ROIC, very consistent. We do like that. In fact, sometimes we don't mind paying a little bit of a premium for companies that have strong and consistent metrics. 20% also looking good on a trailing 12 month. And the operating margin, we don't get operating efficiency, but we do see it straddling around the minimum 16%. And free cash flow, even with the decrease, still not looking too bad, 9% in 2023, 7% on a trailing 12 month. Then we get to the net debt to EBITDA. What we do like here, below 4, but also decreasing from the peaks of 2020, 2.03 in 23, 1.95 on a trailing 12 month, expected to go lower over the next 12. That is a good sign. Management are looking to delever the balance sheet, pay off as much debt as they can. In terms of the valuation, well, ours is $172. Right off the bat, Wall Street have high expectations, 185 in comparison to us. They believe upside of 13%. Then we get to MOS. Well, at 10%, we don't really see that just yet. In fact, for this company, we only see a 5% margin of safety. Thereby, this isn't one that we would be looking to buy. Maybe you could have argument for holding. It does have an attractive yield right now. In terms of going through the MOS, 10% at buy at 155, at 15% at buy at 146, at 20% around 137. So 5% MOS, 13% upside. Is this one you are looking to buy, maybe holding, or in fact considering selling? Give us your thoughts for each one of these today. If you enjoyed this episode, do give us your thoughts below. It is a little bit different than what we typically do. And overall, if value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.